Good day, traders. Chris Weston here, Head of Research at Pepperstone. So we turn the page on what's been another big week for financial markets. We've learned a lot. We've seen some stability coming into risk assets, and as we go into a seasonally strong patch, next week could be a big one. And there's a couple of things which we're looking for, which will potentially drive asset prices higher, or we actually could see further risk coming out of the market. I think one that we're looking at quite categorically is going to be the annual conference, the economic conference in China later in the week. Two factors that we're very focused on. One is whether we're going to see fiscal easing coming through there to try and boost and improve personal consumption. We've already seen Chinese mainland and offshore markets doing quite nicely. There's been outperformance from the Hang Seng, for example. That's been a market that we've been looking at quite closely. And if we do see fiscal easing coming through, whether that's priced in or not is one thing, but that's something we are focused on. The other factor, of course, is whether we see tweaks to their Made in 2025 program, or an acknowledgement perhaps tweaks could come through. And that would therefore be designed to reach out to the trade representative team in the US, Robert Lighthizer, and the committee there, just to try and see if we can see convergence between that situation. Of course, these grey clouds that have been hanging over financial markets for some time could abate partially, and some rays of sunshine could come onto risk assets on that very development. So, they're the two factors. Are we going to see fiscal easing? Will there be tweaks or acknowledgement there could be tweaks to their Made in 2025 program designed to reach out to the US trade representative team? And of course, Aussie dollar could be very sensitive to that development, as they could do on Thursday when we get the employment numbers coming through in Australia. The market will probably be looking for something around 20,000 jobs. The unemployment rate to be fairly similar, fairly unchanged on that situation as well. So we are watching that Australian dollar. There are some signs that does want to move up a little bit in the short term, but it's very leveraged to what we're seeing in the Hang Seng and some of the Chinese equity markets. And if we see those continuing to find solid gains, we could be seeing the Aussie dollar pushing up to 72.50, perhaps even 73. But that obviously depends on the performance we've been seeing there. The other factor, of course, which is going to be a big driver of the US dollar side of the equation, is going to be Thursday's Fed meeting. That happens at 6 o'clock Eastern Daylight Time, and then we see Mr. Powell stepping up and giving his press conference 30 minutes later, 6:30. A couple of things that I'm really looking forward to is the idea that the market is already there and the Fed will come closer to where the market pricing is. If you look at the Fed funds pricing for 2019, we're seeing just under one rate hike being priced in. Of course, therefore, we look straight towards the dot plot projections, which is their estimates for where the Fed funds rate is going to be over 2019, 2020, 21, and the longer term numbers. And with that divergence between one rate hike being priced from the Fed in 2019 and three from their median dot plot projections, are we going to see signs of convergence playing through? Now, I think if you look at the technicalities behind this, all it takes is one Fed member to move their projection lower, and then the medium number will come down, and we'd see the committee looking for 2 rate hikes next year as opposed to 3. So I think we just need one member. So it's going to be a toying cost. I suspect that we probably will see it closer towards 2. The other factor, of course, is whether we're going to see a change to their forward guidance. At the moment, they've been saying for a number of months now that they see further gradual rate hikes. If we see that being tweaked, and I suspect there are risks that we do see that happening, the market's already there. People have been talking about the inversion of 2.5s for a while. That's not a sign of a recession, in my opinion. I think it's a sign that the market sees the Fed ahead of the curve and that a pause is coming. And I think that's something we are very much focused on. Of course, I think we are going to get a rate hike this Thursday. I think that's probably about 70-80% priced in. But it's about what they say is the outlook and how positive Mr. Powell remains in that situation relative to market pricing. I think they do drop that further gradual situation, and I think therefore there are probably some downside risks to the US dollar, which will probably boost the emerging market trade. You're probably likely to see in that situation euro dollar moving to the top end of the range, and euro dollar has been tracking sideways. It's been an absolute textbook range traders market. You've seen the RSI at 50 mid-range. You've seen the Bollinger Bands controlling and containing all the moves as you'd expect to see in that sideways trading market. And if you just put a daily chart of euro dollar, you can see that categorically there, that it has been a range trader's paradise. We really need a break to the upside above 114.56 to suggest that the bulls are actually going to push this one higher. But all signs at the moment suggest, with the ECB moving to a more sort of dovish stance, which I think you saw that with Mario Draghi saying that downside risks had momentum at the moment. And I think that's a factor that we can look at as well. So I think in terms of the Fed meeting on Thursday is something that we've focused on. The other big situation is in comparison to what we saw from the ECB, who remain optimistic that the economic data is transitory, but has said that the momentum to the economics has been to the downside. And therefore, as we go into tonight's session, European PMI series will be very much focused on to see not just if we're basing, but is there any encouragement in things like the new orders component, the new export orders component, that potentially we could see future reads being boosted in line with that sort of more optimistic view that Mario Draghi's been saying. The other one is as we go into next week, we get the IFO survey. Now, there's 3 sub-surveys that the IFO will look at, things like big business, current assessments, the expectations going forward. And those 3 sub-surveys have been deteriorating of late. And that's a big concern for me because the IFO survey has arguably been the best predictor and best precursor of economic performance in Germany for some time. If you go back to the recent GDP print that we saw in Q3, we saw a 20 basis point contraction. The market expects a nice boost up to 50 basis points of growth when we see that number for the 4th quarter being displayed to the market on the 14th of February. That IFO survey, married with the PMI series, will really go some way to making us believe whether we are actually continuing to see downside momentum playing in the Eurozone, or whether we're actually, Mario Draghi's correct in his assessment that potentially these factors are transitory and they expect a pickup going forward. And so I think that IFO survey later in the week is going to be very positive or very influential for the euro-dollar situation as well. So as we go into the new week, we're watching that US-Sino relationship. I think that's going to continue to influence the S&P. We're watching the Fed meeting, which I spoke about there. We're watching the Australian jobs numbers, and there's certainly a lot to look out for. But it's a big week for markets. We'll see how asset prices react there.